Welcome to my Workbook Solutions video on Chapter 5, Accounting for Retail Businesses. Please note that with a few exceptions, the solutions to these problems are presented using the gross method. The following questions begin on page 5 of the Chapter 5 section of the workbook. You obviously don't need the workbook to watch this video, but having it will make things easier if you want to try the problems on your own and check your work. Let's begin by reviewing some sales and purchase entries. Cash sales. On January 3rd, AthensNet sells merchandise for $1,800. The inventory that was sold cost $1,200. To record a sale, we need to book two entries. First, we record our revenue, debit cash, and credit sales for $1,800. Next, we need to remove the merchandise inventory off the books. Debit cost of goods sold and credit merchandise inventory for $1,200. Credit card expense. AthensNet paid credit card processing fees of $48 on January 31st. What's our entry here? Credit card processing fees are an expense. We're utilizing a service from an outside party. Debit some sort of appropriately named expense account and credit cash for $48. Sale on account. On January 12th, AthensNet sells merchandise on account for $510. The inventory that was sold cost $280. Just as with a cash sale, we first record our revenue, but the asset we debit will be accounts receivable since this is a credit sale. Next, expense the inventory off the books as usual. Sale discount. On January 12th, AthensNet sold merchandise to Alpha Technologies on account for $1,500, which cost $750. The discount terms on the invoice were $210 net 30. Alpha Technologies paid $1,470 on January 22nd, taking the discount. Another credit sale, so debit accounts receivable and credit sales revenue for the gross amount of $1,500. Next, expense the inventory as in the previous example. Alpha Technologies paid $1,470 on January 22nd, taking the discount. Debit cash and credit AR, but not for $1,500. Since the buyer is paying within the discount period, it'll pay $1,470 as stated. This is the $1,500 gross amount times 98%. To get that 98%, subtract the 2% discount from 100%. We'll credit AR off the books for the $1,500 amount that was debited into it. Where does that 2% discount, or $30 go? Debit it to sales discounts. Note how when the buyer pays within the discount period, the cash received is 98% of the gross amount, and 2% of the gross amount goes to sales discounts. Estimating sales returns. At the beginning of the year, AthensNet estimated that $8,500 of sales would be refunded and $3,800 of merchandise would be returned. Debit sales and credit customer refunds payable for $8,500. This is the amount estimated to be refunded. Remember that the debit to sales reduces the credit balance in the sales revenue account to the estimated net amount of sales made. Next, record the dollar value of inventory expected to be returned. Debit estimated returns inventory and credit cost of goods sold for $3,800. The credit to cost of goods sold has the same result as the debit to sales. It reduces cost of goods sold to the net amount of merchandise we think we've actually consumed. Recording sales returns. AthensNet issued a credit memo to Johnson Company for returned merchandise, which was worth $225 and cost AthensNet $140. How to record a return. First, debit customer refunds payable for the refund liability being satisfied. Normally, with a refund, a customer is getting his or her cash back, so cash would be the credit. However, the issuance of a credit memo tells us that this was a credit purchase, and the buyer has yet to pay the amount owed. Consequently, we can't disperse cash back to the customer that he hasn't yet paid, but we can credit his AR account. Doing so indicates that he no longer owes us this money. For the merchandise returned to AthensNet, debit merchandise inventory back on the books, and credit estimated returns inventory. If it helps, think of recording a return as a partial reversal of the original sale. To undo the sale, we credit AR to reverse the debit in the original entry. But we don't debit sales. We debit customer refunds payable. We already debited sales when we estimated our sales return in our previous year's adjusting entry. Likewise, we don't need to credit cost of goods sold when the return is made, because we already did so in that adjusting entry. What about sales with coupons? AthensNet sold $250 of inventory for $400 in cash. The customer redeemed a $25 point of sale coupon. How would this journal entry normally look without the coupon? We debit cash and credit sales for $400 and debit CGS and credit merchandise inventory for $250. The $25 coupon reduces the amount of cash being received, so that debit to cash and credit to sales drops to $375. The $250 debit to CGS and credit to merchandise inventory remains unchanged. How do we account for coupons printed on receipts? AthensNet recorded $4,000 of cash sales costing $2,480. 80 receipts were generated, each containing a coupon for $2 off the customer's next purchase. AthensNet estimates that 75% of these coupons will be redeemed. We'll record our journal entries for these sales almost as usual. Debit cash and CGS, credit sales and merchandise inventory. We must debit cash for the amount received, $4,000. That amount won't be our credit to sales. This is because of that $4,000 cash received. A certain amount was an advance payment for a future purchase, as indicated by the coupon. This will be our credit to estimated coupons payable. How much? $120. Take the 80 receipts, multiply that by 75%, the portion of receipts with the coupons we expect to be redeemed, and multiply that by $2 off, the value of each coupon. Plug your credit to sales as $3,880. The debit to CGS and credit to merchandise inventory will be $2,480. Like in the previous example, the inventory expensed off the books is not impacted by the coupons. What do we do when those previously issued coupons are redeemed? For example, AthensNet sold $700 of merchandise costing $440. 15 of those coupons from the previous entry are redeemed. Begin with our standard entries for sales of merchandise. In this transaction, the $700 of merchandise sold is not the cash being received. It's the sales revenue earned. Not all of that $700 in revenue is being received as cash, because we accepted some of those previously issued receipt coupons as tender. The dollar value of those coupons will be a debit to estimated coupons payable. Specifically, $30. The 15 coupons times $2 off per coupon. Thus, the cash collected will be $670. The debit to CGS and credit to merchandise inventory will be unaffected, $440. One more sales transaction with coupons. AthensNet sold $500 of merchandise costing $220. 15 coupons for $2 off were redeemed. These coupons were distributed via newspaper advertisements. How would this entry be recorded? Debit and credit the same accounts as used in our standard sales journal entry. Remember that coupon redemptions will not impact the merchandise expensed off the books. As for our debit to cash and credit to sales, that will not be $500. Instead, it will be $470. We won't utilize the estimated coupons payable account since these coupons are point of sale coupons. Now for purchases. Purchase transaction. AthensNet purchased inventory costing $2,510 with cash. This is a basic purchase transaction from the second chapter of the textbook. Debit merchandise inventory and credit cash. Purchase transaction. AthensNet purchased inventory costing $9,250 on account. Same as the previous transaction, but as a credit purchase. We debit merchandise inventory and we credit accounts payable. Purchase discounts. AthensNet purchased inventory on March 12th that cost $3,000 with terms 210 net 30. AthensNet paid the invoice on March 22nd, taking the discount. For our initial purchase, debit merchandise inventory and credit accounts payable for $3,000. When we pay off the amount owed on the 22nd, we'll debit accounts payable for the $3,000 credited into that account and credit cash for $2,940. The $3,000 gross amount times 98%. Again, that 98% is 100% less the 2% discount. Right now, our second entry is out of balance by that 2% discount of $60. That amount will be credited to merchandise inventory. Note how the credit to merchandise inventory adjusts its balance to the actual cash ultimately paid for the merchandise. This is a manifestation of our cost principle. Purchase returns and allowances. AthensNet returns merchandise costing $900 to Geosystems for cash. When a company returns a previous purchase, the company simply debits cash and credits merchandise inventory off the books. Only the selling company has to fiddle with customer refunds payable. The buyer merely reverses the purchase. Hopefully you're feeling confident. If you haven't already been trying these problems on your own before watching the solutions, try pausing the video here and doing these entries on your own. May 2nd. Purchased $5,000 of merchandise on account from Southwest Data, terms 210 net 30. Debit merchandise inventory and credit accounts payable for $5,000. May 4th. Returned $3,000 of the merchandise purchased on May 2nd. Debit accounts payable and credit merchandise inventory for $3,000. May 12th. Paid for the purchase of May 2nd less the return and discount. To pay off an amount owed, debit accounts payable and credit cash, but for how much? Use a T account to calculate the amount of accounts payable being satisfied. In this case, $2,000. How much cash will be paid? Not $2,000, but 98% of $2,000, or $1,960. Now our entry is off by a $40 credit. We'll put that to merchandise inventory. Why merchandise inventory? Considering what's happening in its T account. Crediting merchandise inventory for $40 aligns the value of our merchandise with our cash payment for said merchandise. Remember our cost principle. we want to record our assets at their cost because that amount is the most objective number. I realize my course utilizes the gross method, but I'd like to cover the same transactions using the net method just for comparison's sake. May 2nd, purchased $5,000 of merchandise on account from Southwest Data, terms 210, net 30. Debit merchandise inventory and credit accounts payable. For the amount, multiply the $5,000 gross sales price by 98% and use $4,900 in the entry. Under the net method, we record the purchase net of the discount because we presume we will pay in time to take advantage of it. May 4th, returned $3,000 of the merchandise purchased on May 2nd. Debit accounts payable and credit merchandise inventory. But the $3,000 in the problem is the gross price. It has not been adjusted by the value of the discount. Since we recorded the purchase net of its 2% discount, we need to record the return reduced by that 2% discount too. May 12th, paid for the purchase of May 2nd, less the return and discount. To pay off an amount owed, debit accounts payable and credit cash. But we need to determine the balance of that payable. Use a T account to calculate that amount. The amount paid, $1,960. Again, because the purchase was initially recorded net of the discount, there was no adjustment necessary to the merchandise inventory for the payment. An adjustment would only be necessary if the payment were made after that 10-day period. In such an instance, we would credit cash for $2,000. Take the $1,960 balance in AP and divide it by 98%, or 100% less the early payment discount amount. Now, to balance our journal entry, we post the value of that missed discount as a debit to merchandise inventory. Prior to this debit, merchandise inventory had a $1,960 balance. This adjustment increases its balance to the cash actually paid for the inventory. Just as in our previous example, our cost principle is upheld. Now, let's record some shipping costs. First off, FOB shipping point. On June 10th, we purchased merchandise from Megadata, $900 on account. Terms, FOB shipping point. To record the purchase, debit merchandise inventory and credit accounts payable for $900. Also on June 10th, we paid freight of $50 on the purchase from Megadata. FOB shipping point means the buyer is responsible for paying for shipping because ownership transferred to the buyer as soon as it was loaded on the truck at the shipping point. When the buyer pays for delivery, the buyer records this cost into merchandise inventory. We debit merchandise inventory because of our cost principle. We want to record our assets at their ultimate cost, since that is the most objective measurement. Obviously, credit cash for the amount dispersed to UPS, FedEx, DHL, or whoever handles the shipping. FOB destination. On June 15th, we sold merchandise to Kirk's company on account, $700, terms FOB destination. The cost of the merchandise sold is $480. Record our credit sale as we've always done. Debit AR and credit sales for $700, and debit CGS and credit merchandise inventory for $480. No early payment discount here, so just use the gross amounts. Also on June 15th, AthensNet pays freight of $40 of that day's sale. FOB shipping point means the seller, AthensNet, must pay for delivery. When the seller pays, it records the delivery as an expense. Debit delivery expense and credit cash for $40. AthensNet sold merchandise to Donderso Company on account, $800, terms FOB shipping point. AthensNet paid freight of $45, which was added to the invoice. The cost of the merchandise sold is $360. Record the sale with our basic two entries, debit AR and CGS, and credit sales and merchandise inventory. FOB shipping point means the buyer is responsible for paying for shipping. But for whatever reason, the seller paid the delivery company beforehand. The buyer won't pay the shipping company since the shipping company already received its money. Instead, the buyer will repay the selling company. How does the seller record prepaid freight? It will credit cash for the amount dispersed to the delivery company and debit AR indicating that it will receive this money from the buyer, the reimbursement, when the buyer pays its amount owed. Sales taxes. AthensNet sold merchandise for $300 on account. The sale was subject to a sales tax of 6%. The cost of merchandise sold was $185. This transaction is nigh identical to our previous sales transactions, just with the addition of our sales tax liability. First, recognize our revenue earned with a debit to AR and a credit to sales. Our revenue earned is the $300, but that amount is not the total cash that will be collected. The business will also collect 6% of the sales price to be remitted to the state and/or local taxing authority. So credit sales tax payable for $18. The total cash that will be collected is $318. Expense the cost of merchandise sold as usual. At a later date, AthensNet pays the taxing authority the amount of state tax collected for the period, $2,900. When the business remits the quarter's sales tax liability to its State Department of Revenue, it would debit sales tax payable and credit cash for the balance in its sales tax payable account. Let's look at some more sales transactions. This information is on pages 8 and 9 of your workbook, but if you don't have it, you can follow along easily with the slide before you. You could also try pausing the video and recording these journal entries from memory, then comparing your results. Starting with transaction 1. A&B School Supplies sold $500 in merchandise to a cash customer. The cost of merchandise sold was $280. First, record the sales by debiting cash for the cash received and crediting sales revenue. Second, expense the merchandise inventory off the books with a debit to CGS and a credit to merchandise inventory. Transaction 2. A&B sold $1,200 worth of merchandise to a customer who charged the merchandise to her Visa card. The cost of merchandise sold was $950. Remember, when customers use third-party credit cards, such sales are treated same as cash because the retailer may deposit the credit card slips directly into its bank, and the card's automated clearinghouse, or ACH, will move the funds from the cardholder's account to the retailer's bank account shortly thereafter. For that explanation, debit cash and credit sales revenue for $1,200, then debit CGS and credit merchandise inventory for $950. Lastly, transaction 3. A and B sold $2,000 in merchandise to a credit customer on a store account. The terms of the sale are $210 net 30. The cost of merchandise sold was $1,600. Here we have a credit sale with an early payment discount. The entry will consist of a debit to AR and a credit to sales revenue for $2,000. Next entry, expense the inventory off the books with a debit to CGS and a credit to merchandise inventory for $1,600. Number 4. A and B accepted a return of $50 worth of merchandise from the customer in number 1. The cost of the merchandise returned was $30. The customer received a cash refund, so credit cash for the amount returned to the customer and debit customer refunds payable. We also need to restore the merchandise inventory returned, so debit merchandise inventory back onto the books and credit estimated inventory returns. Transaction 5. A and B received payment from the credit customer in number 3 within the discount period. This was the $2,000 credit sale with the 2% early payment discount. When the payment is received within the early payment period, the entry is simple enough. Debit cash for the amount received, $1,960, the gross amount reduced by that 2% discount. AR will be credited for the full $2,000 amount debited into the account. As for that 2% discount, debit it into sales discounts. Consider the impact of this entry on the accounting equation. The initial debit to AR and credit to sales increased assets and equity by $2,000. When the cash payment was received, we increased our cash asset by $1,960 and decreased the AR asset by the full $2,000 gross amount. At this point, the equation is imbalanced. The debit to sales discounts decreases equity by $40, bringing both sides into alignment. What if the payment wasn't received until after those 10 days? We'd simply debit cash for the full $2,000 and credit AR off the books as usual. Finally, transaction 6. A and B paid the service fee on Visa and MasterCard sales to Hull Regional Bank, $75. This one's an easy cash expense. Debit credit card processing expense and credit cash for $75. Now let's do our purchasing journal entries. Again, if you like, you may pause here and attempt to journalize these transactions on your own. As usual, we'll start with some review. Transaction 1. A and B purchased $500 worth of merchandise for cash. Debit merchandise inventory and credit cash for $500. Transaction 2. A and B purchased $4,000 of merchandise on account, terms net 30. On account conveys this to be a credit purchase. So debit merchandise inventory and credit accounts payable for $4,000. Transaction 3. A and B paid for the merchandise purchased in number 2. Debit accounts payable and credit cash for the amount owed, $4,000. Transaction 4. A and B purchased $2,000 of merchandise from its supplier on account, terms 315 net 45. Now we incorporate a discount. We'll still debit merchandise inventory and credit accounts payable for $2,000. Transaction 5. A and B returned $100 worth of merchandise purchased in number 4 because it was damaged. Credit merchandise inventory off the books and debit accounts payable for what we will no longer pay, $100. Transaction 6. A and B paid for the merchandise purchased in number 4 less the amount returned in number 5. This invoice was paid within the discount period. Debit accounts payable and credit cash, just as you would any other payment on account. We're paying off the amount we owe as indicated by our balance in accounts payable. $1,900. Our cash payment is not $1,900 though. It is 97% of the AP balance. The discount amount of 3% will be credited to merchandise inventory. As in the previous example, this credit keeps our equation in balance by adjusting merchandise inventory down from $2,000 to the amount actually paid. What if A and B waited too long and missed making the payment within 15 days? Simply debit accounts payable and credit cash for $1,900. No adjustment for the discount required. Flip over to page 12 of your workbook. But if you don't have it, you have all its information right here. Try recording these entries on your own. Transaction 1. A and B purchased $1,000 worth of merchandise on account, terms 210 net 30, FOB shipping point. The freight costs of $50 were prepaid by the seller and added to the invoice. You could book this transaction as one entry, but I'd recommend splitting it into two. Debit merchandise inventory and credit accounts payable for the $1,000 purchase price. Then do the same for the shipping charges. A and B is responsible for paying, but the seller paid for shipping in advance, so A and B will repay the seller for shipping, hence the previous entry. Transaction 2. A and B paid for the merchandise purchased in number 1 within the discount period. To pay off an account payable, debit accounts payable and credit cash. Draw a T account to calculate the amount owed of $1,050. How much cash will be paid? Since A and B is paying in time to get the discount, $1,050 is not the cash disbursement. Reduce the $1,000 purchase price by 2%, then add the $50 freight charge. Now our entry is off by a credit in the amount of that 2% discount. That will go to merchandise inventory to make it match the actual cash paid for the merchandise. What if A and B waits too long to make the payment? It'll still debit accounts payable and credit cash, but for the full $1,050 balance in accounts payable. Allow me to cover the two previous transactions using the net method. If you like, try recording these entries on your own. Transaction 1. A and B purchased $1,000 worth of merchandise on account terms 210 net 30, FOB shipping point. The freight costs of $50 were prepaid by the seller and added to the invoice. For the inventory purchase, debit merchandise inventory and credit accounts payable. We have an early payment discount, so put the amount on the books at 98% of the gross price. Next, record the obligation for shipping and handling. A and B is responsible for paying, but the seller paid for shipping in advance, so A and B will repay the seller for shipping. The obligation to repay the seller is a credit to AP, and that debit goes to merchandise inventory. Transaction 2. A and B paid for the merchandise purchased in number 1 within the discount period. To pay off an account payable, debit accounts payable and credit cash. Draw a T account to calculate the amount owed of $1,030. What if A and B waits too long to make the payment? It will still debit accounts payable and credit cash. AP will still be debited for $1,030, the amount of its balance. How much cash is being paid out? Take the $980 discounted amount and divide it by 98% to remove the discount. Doing so works out to the original gross amount of $1,000. A and B also has to pay the amount owed for freight. So add $50 and the cash credit will be $1,050. Debit merchandise inventory for $20, the value of the lost discount, so that the value of merchandise inventory matches the amount of cash paid to acquire it. This is where we see booking two separate entries as beneficial. Imagine if we had just combined them into one entry. If you forgot to break them back out, the purchase price and freight, and divided the $1,030 by 98%, you'd get a cash payment of $1,051.02. It's not a huge misstatement, but such an answer would be incorrect on any assignment. Also, it's a huge headache when an account doesn't reconcile by some obscure amount, like $1.02. You must then comb through to find the cause and try to rectify it. For these reasons, it's best to keep the entries separate. At least for the duration of this course. As the saying goes, an ounce of prevention is worth a pound of cure. Last little bit of this video. If you have the workbook, you can find the following transaction on page 16 as of the time of this recording. Let's record these entries for both the seller and the buyer. If you want to try these transactions on your own and you don't have the workbook, simply set up two columns on a sheet of paper as seen here. Unless you have a prodigious memory, You'll have to rewind a few seconds and pause the video to reference each transaction. July 1st. Stewart Company sold merchandise on account to Bumble, $5,500, terms FOB shipping point, net 45. The cost of merchandise sold was $3,500. For Stewart the seller, first recognize the revenue with a debit to AR and a credit to sales for $5,500. Next, debit cost of merchandise sold and credit merchandise inventory to remove the inventory from the books. On the buyer's side, record the credit purchase with a debit to merchandise inventory and a credit to accounts payable. July 2nd. The responsible party paid freight of $150 on the July 1st purchase from Stewart Company. The terms were FOB shipping point. This means that the buyer, Bumble, is responsible for covering shipping and handling. Since Bumble is paying the amount, Stewart records nothing, and Bumble debits this payment into merchandise inventory and credits cash for what it paid the delivery company. July 5th. Stewart Company sold merchandise on account to Bumble, $6,500, terms FOB destination, net 30. The cost of merchandise sold was $4,000. Another credit sale. Stewart debits AR and credits sales, then debits CMS and credits merchandise inventory. Bumble will debit merchandise inventory and credit accounts payable just as it did on July 1st. July 7th. The responsible party paid freight of $250 for delivery of merchandise sold to Bumble on July 5th. The July 5th shipping terms were FOB destination, meaning that the seller has to pay the delivery company. When Stewart makes this payment, it'll debit delivery expense and credit cash. Bumble records nothing. July 13th. Stewart Company issued Bumble a credit memo for merchandise returned, $1,500. The merchandise had been purchased by Bumble on account on July 5th. The cost of merchandise returned was $1,000. When dealing with a return, the seller will debit customer refunds payable. Since the customer has not yet paid, Stewart cannot refund it cash, so it will credit AR, hence the credit memo. Next, debit merchandise inventory back on the books and credit estimated inventory returns. The buyer will just reduce AP and remove merchandise inventory from its books. July 15th. Stewart Company received payment from Bumble Company for the purchase of July 1st and July 5th. Now remember, part of that July 5th purchase was later returned on July 13th. These entries go back to Chapter 2. The seller will record a debit to cash and a credit to AR. The amount will be the $5,500 original purchase plus the $6,500 purchase on July 5th less the return on July 13th. The buyer will record the disbursement, debit accounts payable, and credit cash. July 18th. Stewart Company sold merchandise on account to Bumble, $12,000, terms FOB shipping point, $210 net 30. Stewart Company prepaid freight of $500. The cost of merchandise sold was $7,200. Here we have a credit sale with an early payment discount. Stewart will debit AR and credit sales for $12,000. Remove the merchandise with a debit to CMS and a credit to merchandise inventory. For the prepaid freight, debit AR for the amount owed from Bumble and credit cash for the amount dispersed to the delivery company. Bumble will record the credit purchase with a debit to merchandise inventory and a credit to accounts payable. Next, it will record the amount owed to Stewart for the freight with a debit to merchandise inventory and a credit to accounts payable, just like the previous entry. As already discussed, keeping these entries separate will make recording the lost discount easier should the buyer not pay in time. July 28th. Stewart Company received payment from Bumble Company for the purchase of July 18th less the discount. Last entry of the month. Stewart collects the full amount owed within the discount period. Debit cash and credit AR for the receivable collected. The credit to AR will be the balance in Stewart's AR account, $12,500. Because the payment was made within 10 days, $12,500 is not the amount of cash received. The $12,000 purchase price is to be reduced by 2%. $11,760 is the amount paid for the purchase. Then add the cost of shipping collected from Bumble, making $12,260 the total cash collected. Again, notice how the discount only applies to the purchase price. That 2% discount of $240 will be debited to sales discounts. On the buyer's books, the cash received by Stewart is the cash paid by Bumble. Likewise, the receivable collected by Stewart is the payable satisfied by Bumble. Finally, the sales discount that reduces sales for Stewart is the inventory reduction for Bumble. Let's consider how the last two entries would be recorded under the net method. On July 18th, Stewart Company makes its sale to Bumble. Debit AR and credit sales. Under the net method, we apply the discount at the point of sale. So our amount is $12,000 reduced by 2%, or $11,760. Expense the merchandise off the books as usual with a debit to CGS and a credit to merchandise inventory. Prepaid freight also receives the same treatment as in the previous scenario. Credit cash for the amount paid to the delivery company, and debit AR for the amount to be repaid from Bumble. On Bumble's books, debit merchandise inventory and credit accounts payable for $11,760. Bumble will record the prepaid freight with a debit to merchandise inventory and a credit to accounts payable. Note that Stewart's receivable is Bumble's payable. When the payment is received on July 28th, Stewart will debit cash and credit AR for the balance in accounts receivable. $12,260. On the buyer's books, the cash received by Stewart is the cash paid by Bumble. And Stewart's receivable satisfied is Bumble's payable satisfied. No adjustment is necessary for the discount since it was applied at the sale and the buyer paid within 10 days. What if Bumble didn't pay until after July 28th? Stewart would still debit cash and credit AR. AR will still be credited for $12,260. One can only credit accounts receivable for the amount debited into it. However, the cash collected will be adjusted for that missed discount. So take the $11,760 purchase price and back out that 2% discount. Then add the $500 collection for prepaid freight. The discount did not apply to shipping. That 2% discount will be credited into sales revenue. This way, the total sales matches the actual sales price. For Bumble, $12,500 is the cash paid, and $12,260 is the debit to accounts payable. But the lost discount will be debited into merchandise inventory to adjust inventory to its actual cost. Let's finish things up with a few more examples regarding sales promotions. ExoShield Athletic Wear sold merchandise to Victor Tillery in the amount of $200 cash. The cost of the merchandise was $110. Printed on Victor's receipts for this transaction included a coupon for 10% off a future purchase of $20 or more. Record this entry. Let's presume that about half of receipt coupons will be redeemed, and the average sale upon coupon redemption will be $40. To simply record our basic entries, we would debit cash and credit sales for $200, and debit CGS and credit merchandise inventory for $110. To incorporate the coupon issuance, within the sales journal entry, we would credit estimated coupons payable for $2. When the coupon is redeemed in the future, it will likely be 10% off a $40 amount, but there's a 50% chance the coupon will be redeemed at all. To keep our journal entry balanced, we will reduce sales by the value of that liability. Effectively, it's like we're treating $2 of the cash received as an advance payment on a future sale. Denise Thompson purchased some athletic shoes from ExoShield Athletic Wear for $125 in cash, which cost the store $55. Denise presented a coupon she received in the mail for $20 off. Record this entry. For point of sale coupons, debit cash and credit sales, but not for $125. Treat the coupon as a $20 reduction in sales price. Expense the merchandise off the books as normal. Rena Mehta made a cash purchase, $80 for sporting equipment costing $35. She presented a coupon from a previous purchase's receipt for 10% off a future purchase of $20 or more. Record this entry. When receipt coupons are redeemed, they are treated as a reduction in the cash received. In this example, we will credit sales for the full $80 sales amount, but debit cash for the amount received, $80 less 10%. That $8 difference will be debited to estimated coupons payable. Doing so satisfies the previous recorded liability. Debit CGS and credit merchandise inventory as usual. Let's consider this last example independently from the previous few. At the end of the period, ExoShield Athletic Wear has generated 80,000 sales receipts with coupons printed on them. EAW estimates that 25% of those coupons will be redeemed and that the average redemption value will be $15 per coupon. Record this entry. Sometimes, companies may record a year-end adjusting entry to report a more realistic or reasonable balance in the estimated coupons payable account as of the end of the year. Remember that companies should not over-report their assets or under-report their liabilities. In this case, EAW would debit sales and credit estimated coupons payable for $300,000. This amount being the 80,000 sales receipts times the 25% likelihood of being redeemed times the $15 estimated redemption value per coupon. The key takeaway here is how recording this liability is a reduction in sales. As these types of coupons are redeemed, they are recorded as a reduction in cash received. That concludes this video. I appreciate your watching. If you would, please consider offering me a temporary subscription, and you may find me in the next one.